I think in general, a consumer would certainly prefer deflation to inflation. But in terms of the risks on the horizon or risks, I still see the weightier position on deflation. And I guess the most immediate example of why I would feel that way is the last time the Fed burst an asset bubble that they themselves had deflated back, or the housing bubble burst, and then we had the follow-on global financial crisis. And in July of 2008, just as that financial crisis was really getting going, the CPI was 5.6%. It's funny because I don't even remember, I didn't realize till I looked at that we actually had inflation in the fives back during that whole housing bubble heyday. So we had 5.6% inflation in July of 2008. 12 months later, the CPI was minus 2.1. So I guess I glibly like to say nothing cures goods and services inflation like asset deflation. So I think that's a very real possibility, just because obviously we're going to have a mother of a reverse wealth effect as people get their 401k statements and they see to the idea that they've taken some pretty big paper losses. And we still haven't even seen the housing shoe drop yet. We've seen the shoe drop in terms of volume, but the price declines are still in the pipeline. And given the dramatic decline in sales that we've seen, which actually have slowed even faster than they did when the housing bubble burst, we should expect to see some pretty dramatic declines in prices unfolding over the next few months. That is a huge contributor to the CPI. Shelter component alone is about a third of the total inflation measure. And I went back and looked at this as well. That is a very, very lagging component, not surprisingly. So you had the peak in home prices in September of 2005 when the housing bubble was inflating. That was the peak. And then they started to deflate as the Fed's rate hikes worked their magic on the housing market. The shelter component of the CPI didn't peak until February of 2007. So that's nearly a year and a half later, at which point the median existing home price was down 2% year on year. So we were in the midst of really rampant asset deflation in terms of home prices, but the shelter component of the CPI took almost a year and a half to begin to reflect that. So I think we're really, I guess my long-winded answer to your question is that the inflation that people are so lathered up about and they're extrapolating infinitely into the future, I think is largely rear view mirror. I think a lot of the factors that are keeping the headline numbers up have already reversed under the surface. It's just that the statistics haven't yet caught up to that reality, but they should over the next 12 months. The fact that people are living inflation right now is probably the strongest argument that the inflationistas have, in that the longer people begin to get used to higher prices, the more that has the potential to feed on itself, because what they do is say, I better buy more of this before it goes up in price. And you have that effect where it pulls forward a lot of consumption and helps feed an increase in prices in general. Obviously, we have seen decades of the exact opposite of that in Japan, where people just became so accustomed to prices always going down that they had no rush to go out, no impulse to buy things, because hey, if you wait a year, that car is just going to be even cheaper. So the psychology of inflation is probably the strongest argument that the people who think it's going to be more sustained and long lasting have in their I always think of the Fed as a car analogy, and they've slammed the brakes too hard. And then what happens is we get into that scenario where the wheels are coming off the economy. They're now pushing the gas, and basically they're flooding the engine is the way I think of it. Like, it takes a long time and they're pushing so much liquidity out there, but nothing's happening. That's normally what you get at the very bottom there, because you're still working off the delayed impact, as you said, of all of the tightening. It's interesting because I guess I shouldn't say everyone talks about the long and variable lags of monetary policy. Everyone should be contemplating the long and variable lags of monetary policy and trying to figure out when we are going to start to see the impact of the first rate hikes back in March. And I think clearly the front lines, which are housing, the most interest sensitive sector, obviously has really started to respond to those rate hikes. But in terms of the broader economy, all of that pain is still moving through the pipeline, which you astutely pointed out there. That's going to take a long time. And if we're starting to just feel the effects of the March hike, we've had unprecedented rate hikes over the 5 months and 6 months ensuing. So there's a ton of pain that is going to be unleashed here that I think you're 100% correct that neither Wall Street or the Federal Reserve are really mentally prepared for. So I think that's going to be a really big story for 2023. And I would just say, for example, to get a sense as to when we would start to really see the impact, I did an overlay of that NAHB home builders survey, which I'm sure you saw hit another new low. And that being obviously a leading indicator of the leadingest indicator in the economy, the housing sector. I overlaid that with the unemployment rate. And it usually takes 12 months for the NAHB peak to manifest in a peak in the unemployment rate. So we're basically there. If you look back 12 months ago to when the NAHB survey peaks, really it should be any minute now that we're starting to see the impact. And the same thing is true on the corporate credit side, where when interest rates bottom, it takes about 12 months after the U-turn in interest rates to deliver a U-turn in corporate defaults. So we should be starting to see some real deterioration in the corporate credit space. And I think both of those would obviously change everyone's thinking around this whole inflation debate. But we will see. We'll hear a lot more this afternoon when the Fed gives their and Powell talks to the presser. If you listen to what all the Fed pontificators have said, that they're talking about pausing, just reaching whatever you think their terminal rate is going to be. They're not talking about cutting rates. Yeah, they may be forced to if we have a repeat of a 2008 style market crash. But right now, that's not the game plan. And that being said, you don't solve anything. So let's say they tighten to 4%, for example, on the Fed funds rate. And that's it. And the stock market goes bananas because they say, okay, that's it. We've got our pause. The worst is behind us. As we just talked about, the worst isn't behind us. It's just coming through the pipeline. So give it a minute. But also, from the standpoint of the impact of higher interest rates, you're not alleviating anything. Mortgage rates will still be at 7%. Junk bond yields will still be at 9%. Investment grade bond yields will still be at 6.5%. So as those obligations roll, they mature, and you have to roll that paper at these substantially higher rates, you're going to have credit issues. You're going to have rising delinquencies and defaults. And there's no way to stop that, barring taking rates all the way back down to where they were before the Fed even started this whole gambit. So I don't think it solves anything. It just makes the pain in the pipeline less severe. We have what's coming, we just don't add more to it. But there's no escaping the consequences of the rate hikes that the Fed has already undertaken. Yes, I would be selling that rally. I also think, as you've listened to me drone on about ad nauseum many times prior, that we're going to have a really severe corporate profits recession, and having the Fed not in a neutral position in terms of the liquidity, maybe they're not adding, but they're not subtracting anymore, doesn't help if the fundamentals are deteriorating. You need one of them to be supportive, and we would enter an environment in 2023 where, let's say, at best, monetary policy is neutral, liquidity is neutral, but the fundamentals are rapidly deteriorating. That's not a backdrop that I'd be rushing to buy stocks in.